Hello, everyone. Welcome in. We are so excited to have you here today. One of our favorite days is a day where we get to launch a new deal to our investors. And this one is particularly exciting because it's actually in my backyard. I'm native of Atlanta, Georgia. It's a market that we're absolutely in love with, has a large percentage of Fortune 500 companies, a very dynamic growing population. And this particular deal we're going to discuss is in an incredible submarket of Atlanta that has so much going for it. We're going to dive into all these details, but just some quick hits. So this market has grown by 20% in population in just the last 10 years and is projected to grow another 11% in the coming five. So that means more residents moving in, strong economic activity in the area, major employers in the area. So this is a deal you do not want to miss out on. We're going to go through a lot. We want to cover everything, right? The market, the deal, the business plan, the projections, everything. So get your pencils out, write down your questions. We'll be doing a Q&A at the end. But once again, we're really excited to present this deal. Mark and I, have been known each other for many years, and I can tell you this is one that we're really pumped to be here discussing today. So, Mark, welcome in.
Yeah, it's great to be here, John. Normally I have the mic in on whenever you and I are having the conversation when we're doing our podcast, right? But this is going to be a little bit more of a, we'll just say, kind of a little bit more relaxed conversation, and I'll be presenting the actual deal itself. But it's kind of nice not to have the mic there in front of me. But
Yeah, that's right. A
that's
little more
great to
freedom
be
of
here.
movement, you know. Yeah, and if you're on this call, you're here watching this webinar, maybe chat in where you're watching from. Mark spends a lot of time between Canada and Florida. As I mentioned, I'm here in Atlanta, so we'd love to hear where you're at. But Mark, I'm going to go ahead and share the presentation so we can dive in. How does that sound?
Yeah, sounds wonderful. John, you mentioned we're excited. This is in your backyard, which we really loved. I know when we were looking at new markets to add, because one of the reasons why we were looking at another market was that for us we have just such high standards, and it was really came down to like 1 in 300 deals is what it came down to, and we in order to fulfill this need, our assets are doing extremely well. We really wanted to open up to another market, and we weren't just going to open up to any market. We wanted to open up to a market that we felt not only it hit the same, it had the same story, and it had that same kind of upside. And when we added Atlanta, I know you were pretty stoked that the numbers aligned with your backyard, which is pretty amazing. And this property, we had to go through a lot to find this. This is like 1 in 300, and we're super excited to go through. So this is going to be, when I recorded, it was about 30 minutes. I'll definitely get done by quarter 2, and then there'll be a Q&A, as you mentioned, after. So we'll make sure to answer your questions, and then there'll be an opportunity for you to book a one-on-one to, you can book it. We can get into any of the personal questions or any one-offs. And then there'll be a reserve button will be in here as well that we'll be putting through the chat as well. As we're going through, I want to really encourage you, this deal and this opportunity. We have a wait list now that's prepared to come in and invest in this. And so we're launching this officially as of today. So I want to encourage you guys that if there is any questions as you're going through, write them down. Let's get them answered, and for you to be able to make a decision. And that would be my ask and encouragement, especially in this market today, is that if you're just not sure, just make a decision. It's a yes or no. And the best way to be able to get a yes or no on this is to be able to book that one-on-one, so we can actually have that conversation as well. So keep that top of mind moving forward, because I'm a firm believer, and the data is telling us that this is one of the a phenomenal time to be buying in the market, where we're buying at 20-30% discounts from the peak of the market. The last couple of years, there's been very minimal building that's happened. And so the case moving forward from our data points is that there's going to be really strong rent growth as well. That's what the data is telling us. So I'm extremely excited over the next 6 months of where the market is right now. There's a lot of pressure for lowering interest rates, and we all know what happens when that happens in real estate. Trump is really pushing on that right now to lower with the Fed, and that case is happening. And then there's also from a market standpoint, when it comes to the multifamily, is a very different case than a lot of other markets. So I'm going to be diving into that a little bit as well. So let's go ahead, John. Let's share the screen and let's dive in. So just to kick off, guys, we always start with when it comes down to a disclaimer that we always recommend getting accounting or lawyer's advice when it comes down to it. And so again, we're not accountants, we're not lawyers on that. So we always think that's a good thing. And I've even jumped on calls with accountants in the past, and they asked their questions direct, and it was very short conversation because how we structure these deals is very tax efficient for both Canadians and on the American side. I'll be talking a little bit about that structure as well. The other thing is that Equivesto is our exempt market dealer on this. So from a securities compliance standpoint, fully compliant on this. And all of our investors go through Equivesto to actually invest. And we brought Equivesto on. They've been doing a great job for us to date. So quick outline, quick overview, high level of the deal. This is going to give you a good understanding of what it is, the team, the background, which is pivotal to these larger multifamily deals, the market, the property. We're going to be diving into what the business plan is. We'll jump into the financials, and then we'll make it super clear what the next steps are moving forward. All right, so top 5 reasons if we were to dive in. First off, between operational efficiencies and rent lift, there's $326 per unit average monthly upside in this particular community. So there's really strong upside in this, and this just means that we go in from day one. From day one, it's actually cash flowing, so it's taking care of all the expenses. And if we just go in and we start executing on our value add business plan, we know based on we've shopped all the comparables, so we've walked through the different properties in around the area, and we verified, yes, we do in fact believe that we can get this amount extra in rent. And so this is something from a due diligence standpoint. These are projections, and very confident that we'll be able to deliver on this. The last 4 assets that we've taken down, we've overshot our projected upside rental lift. And so this is a very important data point. The second thing, which is actually one of my favorite things, is that this community is actually 28 minutes from the busiest airport in the entire world. So believe it or not, Atlanta is actually, it's a hub for many different locations right across the world. And so anytime you're close to an airport like this, especially a major international, this is a very good business case for real estate. I mean, if you're in Canada right now and you're, say, close to Toronto, just go out 28 minutes from Pearson International and look what the real estate prices are there. This just means that it's closer accessibility if you want to travel, but this is a very strong business case for infrastructure to be built up. They want to be fairly close to an airport as well moving forward. So 28 minutes, this is a very, very attractive part to this overall deal. Now, Newnan rents are projected to increase 19% over the next 5 years. And so we do a very thorough background check in regards to the new deliveries coming online. And over the last few years, there's been very minimal. And 25 and 26, it's little it's very little that's going to be coming on from a new inventory standpoint. And we can dive into the more specifics of that at the end of this. But very strong upside in this when it comes down to rental growth. Now, the other thing is that this is very rare in the sense that there are 7 units. You can look at that picture up above. There's 7 units, 7 apartments per acre. Now, we've acquired other assets that were like close to double that. And so what this means is that when a resident is living here, they don't feel like they're on top of each other. And so we're buying quite a bit of land here as well. And the other thing that's really interesting is that this community actually is zoned for 8 additional units. Now, that's not part of our business plan. We based on our business plan, it's nice that it's there. It does add value, but we're going to be packaging this up when we look to sell in 3 to 5 years for that next purchaser, and that's going to be some further upside. So it's built-in upside as well on that end, and residents really love the space. When you go and drive through it, it really does feel like it's spacious, which is a big differentiator when residents are looking at our community and looking at the competition out there. We're always thinking about competition as well. Now, the other thing is that we're purchasing this well below replacement cost at $191,228 per apartment. So well below replacement costs. And so these are the top 5 reasons why we love this deal. Now we're going to move in on here and dive into a little bit of the numbers. The overall equity on this is 11.825 million is what we're raising. We are getting a first mortgage on this, 14.625 million on this. All in is sitting at $26.45 million for the acquisition. Purchase price was at 21.8, so 191,000 a unit. All of our CapEx, our renovation budget, is sitting at 2.112. And then all the soft costs from financing to exempt market dealer fees, legal accounting, prepayment penalty, we factor that into the exit as well. The equity placement, equity under management fee, and the acquisition fee as well, and yield maintenance as well is all included in that 2.537 million. So everything's been factored in when it comes down to the overall costs. And those are the high level numbers when it comes down to the overview of the investment. Now you can see the submarket. So the market here around Newnan, this community is situated like right in the heart of Newnan. Now, so 28 minutes. So if you look at a map of Atlanta, it's southwest of Atlanta. So 28 minutes from the airport. But take a look at all the employment lands around. We were just talking about this with some of our senior leaders, and the Yamaha plant, you can see on there 2,000 employees. It's just minutes away. You have the hospital as well, 1,300 employees, minutes away. And so you can see right across the board, you have the Amazon fulfillment center, 500 employees. So these are like really good paying jobs. And so this is very, very strong that we're buying in a community that, there's lots around in it. And then there's lots of great jobs, because jobs attract people. And if they're making good money, then that means they can afford their rent. And everybody needs a place over their head, which is one of our key thesis points moving forward with these assets, is that everybody needs a roof over their head. And the renter segment is actually growing because it's harder and harder to be a homeowner with the rising housing costs. So we've actually added a profit share segment, and we've segmented this down. And it comes down, there's like 2 main share classes. So Class A is for anybody that is looking for higher cash on cash returns. So this just means that, let's just say you like to have higher monthly distributions, and that's more important than, say, a sharing profit in the back end. What we've done in this asset is we've actually raised that to 12% cash on cash returns. And so that is a Class A share. Now, the upside about this is that the Class A shares are actually paid out first. So if security is like one of the things that it's like, this is the most important thing, I want security, then this option is actually could be a good option for you. You're getting 12% cash on cash returns. It is return of capital. So that means that there won't be any tax consequences until we actually sell the asset in 3 to 5 years down the road. We're returning capital, which is great for tax efficiency, and is paid out first. So it's situated higher up in the capital stack. If you think of a waterfall, this bucket is paid out first. Now we're only allowing 1.5 million of the 11.8 million that is to be permitted in Class A shares. And so once that's filled, then we close that offering up, and then the rest will be in B, C, and D. Now, the only difference between B, C, and D is that the more you invest, the higher your return is going to be. Okay. So where this higher return comes from is that actually comes from Faris Capital's profit at the end of the sale. So some people call it a promote. Some operators call it a promote there on the back end. So what this means is that anything between $100,000 to $249,900 is getting paid at a 20.03%. And then once you hit 250 to 750, then it jumps up about a 1.2 percent on an overall year over year return. And then anything over 750, you can see is 22.63. Now for B, C, and D, I'm going to show you in a second here that there is still cash flow from that. It starts at 5 and works itself up to about 6.5. But to keep this simple, Class A is you're getting cash on cash 12% with no participation on the back end. So that's your total return. In Class B, C, and D is you're getting some cash flow, but you're either getting 20 to 22% depending on how much you invest. So here's a further breakdown on the Class A shares. So 100,000, that is our minimum to come in on. You can see year one, you're getting paid out. It's $1,000 a month. We have monthly distributions. And so these monthly distributions there are paid out until we actually exit the asset. And that's 3 to 5. In here, we've shown 5 years. And again, this is paid out first as well. You can see if we go to the next slide, Class B, C, and D is all based on how much you invest. So the 100,000, you could see that is paid out at it basically doubles, and then you have that 5% is what it starts at $5,047. And then you can see every year as we're executing on our business plan, it grows. And so the more you invest, the more your end number is here as well. And so that comes from Faris Capital's promote. Now, if you were to say, okay, what's the order of getting paid on the B, C, and D? B, C, and D is there's an 8% preferred return. So this is an incredibly strong offer that we are saying to our investors that 8% is the first 8% per year is actually going to our investors. So all the cash flow goes to the limited partner investors. And when John and I invest personally, we invest on that side, on the LP side as well. So the first 8% is paid out to the investors. And then from there, it goes to a 70-30 split, 70 in favor of the investors and 30 to Faris Capital. And then from there, after a 15% internal rate of return, it goes to a 50-50 for B class. And then so C and D, you can see there's a more favorable final split there. In C, you can see it's 65% that goes to the LP, which is the yourself, the investors, and then 35% to the general partner, which is Faris Capital. And then you can see Class D, it actually is a 70-30 all the way up. So investors get 70% of all the upside, which you can see that's how we get the higher return on that side as well. We added this because we had a number of investors that were coming in at that higher amount. And so we said, you know what, they're investing more, they're playing a bigger role in taking these. So we wanted to be able to reward them as well. All right. So the team, this is generally what there's the big three are the market, the deal, and the team. And so the team, I can say in a very clear way that the team that we built, this is our senior leadership team. I will put our team up in the execution against any other operator out there. And it took us a while to be able to find this kind of talent. Initially, it was so Madison and I actually we had started, and basically from there, John had come in as a partner as well, and John brings some phenomenal operational experience. He scaled up a $100 million company and had a really strong exit. Came on and as a partner, and then Joe Lowry has $1 billion of acquisition experience, has very strong track record, and then Georgia as well, 20 years experience, very strong track record on the execution. Joe he finds the deals and does the underwriting, and Georgia executes on her business plan as well. So there's not much that they haven't seen through their years of experience on this. And then Madison ensures that all of the K1s and the T5013s on the Canadian side, the tax slips go out on time, and that all distributions go out at the beginning of the month on time as well, which is it's nice to know that there's a full-time CPA in our organization that ensures that the payments go out on time. And Madison's one of the most detailed people that I know. So you're in good hands on that from a team and execution standpoint. So currently, right now, we have 185 investors in our projects. We've deployed 50 million in equity. We have over 500 residents in Faris Capital managed properties. So, you can see here the mission is something that we established early. Is that our mission is to go full out for our clients, provide the best investing experience in the world. This is like our purpose or why of our company. John and I, with our background in delivering great experiences, this is what we said at the beginning. This is what we want this company to stand for. And then we have our 5 core values that all of our team members filter our decisions through. And it's interesting because we've actually taken these same core values and we put it in every single one of our communities, Faris Residences communities. And we tweaked the mission is to go full out for our residents and provide the best living experience in the world. So that's in all of our assets at the in the leasing office there as well. And this just shows our residents that we actually care, and this is how we make decisions at the end of the day. Quick case study here. This was our first asset, Faris Residences Largo, 104 units. We 20% discount we got. Now we're overshooting. We have average rent lift between our renewals and the new leases at $312 per unit lift. So we're overshooting our projected rents. You can see the before and afters as well. There's an asset across the street there, 300 units. And when we took this asset over, because we moved so fast on it and we did such a good job, we had a number of residents walk across the street and say, "Hey, I like what you're doing. I want to come live here." They like the area and they wanted to live there. So this has been a real strong success story. And the community is actually changed in a really great way. So the team's executed extremely well on this. And you can see some of the rent lifts that we're getting on this asset. The average rent lift on the renovated units, you could see over $600 rent lift. So what's really interesting and good for any of the Canadian investors or any of maybe the blue states that you're listening is that there's no rent control in the markets that we invest into. So there's no sort of restrictions on what that actual lift is. And so when somebody moves out and we renovate, we can go in and raise rents for sure. But even on the renewals, generally what we do is we don't do it all in one year. We'll break that down over a couple of years, the renewals. We'll give them an option at the new renewal rate or they can actually move over to one of our renovated units. Another case sample here as well, or study is this is actually 2 assets. It was 272 units that were about 20 minutes apart. We actually packaged this up into a portfolio in Charleston, South Carolina. The before and afters there we did on budget for about 14,000 a unit. We bought this at a strong discount, and our average rent lift on this is $350. So we're overshooting there. All the distributions are on track there as well. And take a look at some of the rent lifts that we're getting, $623 rent lift on a renovated units as well. So this is another great success story as well. It just goes to show when we do our due diligence, we put so much time and focus into doing that. And we know we're going to need to report back once we close to our investors and how we're doing. And so we put a lot of due diligence in, but this is just showing you that whatever we project in regards to the upside, if we can hit or exceed that, that really is kind of the canary in the deal as to how it's performing. And so this is a big part of being able to hit these projected returns. This was one that actually was in between the 2 assets in Charleston that came up. We actually chased this for quite a while, 36 units. It's a little bit of a smaller deal, but because of the efficiencies being close to the 2 other assets there, we were actually able to share some of the property management and lower overall costs for all the assets. On track here, you can see the before and after staying on budget, and you can see some of the rent lifts there on the next slide. So the bottom 3, these are our average rent lift there. You can see that. But I wanted to include some of the renewals to give you guys some context that with the renewals, what we do in general is we'll do it, say if it's $300 lift upside, we'll do that in a period generally of like a couple of years. So you can see there's like $150 rent lift. The following year, we're going to do the same thing. And so this just helps maintain occupancy. And so Georgia does a good job of being able to kind of, look a couple of months down the road, 2, 3 months down the road. Okay, what are the upcoming renewals? And then having those conversations with the residents before their lease expires. And one quick one, we just actually closed off another one in Georgetown, just outside of Charleston and Myrtle Beach. This was 66 units, and that particular deal we filled fairly quick as well. So that's an asset we're looking to close within the next 30 to 60 days. So why Atlanta? I mean, other than that's where John lives, and of course, the John wouldn't live in anywhere that's not a good spot, right? So, but Atlanta, it really is. I mean, it's a massive area, and so Atlanta as a whole, we're going to start up top and then we're going to break down into Coweta County. And so, but at a very high level, I mean, there's Atlanta region is looking to grow to more than 8 million people by 2040. So it's a growing area and it's part of kind of the halfback trend. There was a lot of people that were actually moving way down south and they realized, oh, the summers are actually pretty hot down in Florida. And so there's a number of people that actually move halfway back. And so the case is still strong where it's still affordable. It's landlord friendly for investors, so there's no rent control. The affordability is a really big part of it. We like investing into properties that have under 30 to 35% income to rent ratio. So if the average income is 100,000, we like after we renovate to be 30 to 35,000 of their total overall income. And so they have lower property taxes here as well, and it's very diverse when it comes to industry. So for example, if you would have invested in Detroit back when the automotive left, your assets, your real estate assets would have got demolished. It's like property pricing dropped in half. And so we never like investing into any area where it's very reliant on, say, military or another maybe it's like highly in automotive in one sector. We want to make sure that we're very diverse, and Atlanta paints that picture very, very well. Coweta County here, again, very strong growth, population growth. Overall, 19% rent increase is what they are, and fairly great incomes as well. Overall, and home values have done fairly well, yet they're still affordable to be able to move in. Where a lot of the other assets, will say a lot of these other areas, their pricing's grown so much where it's hard to be able to afford. But this is the same on the rental side of things as well. Very affordable area. This gives you a breakdown. Okay, 26% is professional and management, but again, very diverse when it comes down to the breakdown in the industry there. And we showed that slide up above of right around the asset, the type of employment that we have, and so very strong paying jobs and is very diverse as well. Here are the major employers, Delta, and these names. I mean, Home Depot, Marriott is a big one. We saw in there's Amazon that's right there as well. We have the Yamaha plant as well. These are massive, high-paying jobs that employ a lot of people. And so you want to be close to this. This is actually a very good determinant on real estate values is the jobs and what they're paying their staff. All right, let's dive into the property. I was telling the team, I love this slide. This slide does such a great job at showcasing the asset. So it's really simple. There's 4 buildings that are stacked in 2-story towns, and these are the 1 bedrooms on the right-hand side. So if you look at the numbers 52, 40, 30, and 22, these 4 buildings, these are the 1-bedroom units. Now, really good, they're generous size apartments at 837 square feet. There's 32 of those. The quads, which are basically bungalows, okay? They're bungalows, but there's 4 bungalows that are connected. So they walk in on the main level, which is great. There's 60 of these 2 bedrooms, and then the towns, they're 3 bedrooms, and get this, they're 1,750 square feet, 3 beds, 3 bath, and there's 22 of those. So the good news here is that if somebody's in a 1-bedroom and they love the community, they don't need to move out of the community if they need to have more space. We'll bump them up to a 2-bedroom. or a 3 bedroom, or maybe they have a 3 bedroom and the kids moved out and they love the community, they need to downsize. They can do this here. So the unit mix is actually, it's another significant part of this asset and why we love it so much. Now, you can't see it here, but on the right-hand side, you can see kind of that green space. There's some storage there, units that are being used right now by the maintenance team. And we're actually looking at that as some potential storage areas to be able to charge for that. Now, that's not even in our projected income. And so with that, we're looking at that as like gravy in the deal if that comes together. But that is positioned really well to be able to generate some further income on this. All right, floor plans, you can see they're smart floor plans. The 1 bedroom, you can see the 2 bedroom, and we'll make sure you guys have the deck going out after this so you guys can take a closer look as well. And then you can see the 3 bedrooms there as well. They're the 2 stories. All right, business plan, let's dive in. So this is really what we're known for in a big way, and I'd say is one of our key differentiating advantages. For us, when we take an asset over, the first 4 weeks, we want to make an impression. We really do. And so we we operate very different than other operators where it's like, I'll get to it, in 6 months or 12 months or whatever. And for us, it's like when we take possession of the asset, we know the residents are watching. They're watching. And so instead of coming in saying, oh, we're going to do this, we're going to do that, we're big proponents in showing people first and then telling them what we've done. And so we want to come in and add a lot of value as fast as possible. So the first thing we've done, and with John and my background building companies, is that first culture smokes strategy for breakfast. And I believe that was Jack Welch that said that. And so for us, our mission is to help. This is a really great culture to start with, but we know we can take it to the next level. We want to elevate what the community's culture is. And so we come in, here's our mission. It's right there in the leasing office. Here are core values. And big part of this is actually who the leader is, the property manager. And so the leasing agent, the property manager, we want to make sure that they're solid. In some cases, we transition. In some cases, we maintain. And so for every asset, we actually go through a full vetting process to make sure we have the best people there. That is actually one of the biggest determinants of how community is the not only the execution but the results of a community over an asset is how well and how strong the property manager is. Do they build relationships? Do they move quick when there's an issue? And so what we did was we said, okay, how do we ensure that we're delivering on great service? And so we offer these 3 guarantees. Happy living guarantee. So when they move in within the first 30 days, if they're not happy, they can actually cancel their lease. The second is in your corner. If some family member passes away or they lose their job and they need to move, we don't hold them to a lease. And so we tell them that up front. And then number 3 is a big one. The number one reason why that people move out of communities and rental communities is that they had a maintenance request and it didn't get fixed fast enough. Quick example, I was getting my hair cut one day and this barber was, he's really upset and said, what's going on? He's like, my landlord, he's pissed. He's like, my landlord, I've been telling about this toilet for months now. It's been leaking. I mean, you think you'd want to get it fixed because it's leaking water. And finally, I told my brother, I called my brother, and he came over and fixed it. And he's like, I'm moving out. And he told me this. I was like, oh, geez, like, yeah. He's like, you could tell he was fuming. And so we want to make sure that when there's an issue, we're on it. So if we don't fix a maintenance issue within 48 hours, we actually give them a concession. We tell people this. So this holds our team accountable, and it's a canary. If we keep seeing issues, then it's going to come to our attention. Number 4 is exterior updates. We do, like that Largo asset that we showed you, we got all the buildings done all within 4 weeks. Exterior updates, the vacant unit renovations, we go in and professionally stage it as well. The amenities update as well. Dog park, we look to upgrade the amenities, the staging of the leasing office and the model suite, and then we host a resident appreciation event, and we get a lot of feedback on that as well. And so that's what we look to do. And so in this case, for this asset, we're not looking to do 100% reno on this. We're looking to renovate about 68% of the units or 78 units. And so Why we want to do that? We want to keep a little bit of meat on the bone. We always look at who's going to be buying the asset in 3 to 5 years. And we want to be able to say, hey, listen, we've proven out the business plan with our renovations. We're getting X amount more. If you come in and renovate, you can do the same thing too. So that provides more value and it actually opens up our buyer clientele to not only high net worth investors down the road, but any other real estate investment firms like us that come in and execute on these deals, and they'll pay a premium for that as well. So that's who we're going to be targeting moving forward. But yeah, you're going to see some before and after pictures here in a minute. But you could see we're looking to kitchens of that. We're looking to add some valet trash as well, and to the separate from a storage standpoint as well. We're looking to do. The exterior, you can see, well, first the pool area, we want to upgrade make it feel more like a resort. Enhance the walking trails, the landscaping as well, upgrade that, add a dog park as well. And then yeah, upgrade the unit, the model suite and the leasing center as well, upgrade the mailboxes. Now the pickleball, we've actually got feedback when we did due diligence on this asset that there's a basketball court there. So we were thinking of doing pickleball, but it seems like the basketball court is like a big hit. And a lot of the residents really love it. And they police it as well. If somebody comes in from another community, they're like, "Hey, you're not from this community," so we might actually keep that as a basketball court as well, and then new monument sign as well moving forward. It's interesting. We did the due diligence on this, and so we were on site. The team was on site last week, and leaving that asset, you could see everybody's eyes were like, "Oh, I like this asset even more," after doing all like the inspections and whatnot. So that was a very good thing. So here's some before and afters. This is the quads or the quad bungalows there, but you can see the before and after. We're looking to rinse and repeat what we've done with our other assets, and so you can see the interiors there. That this has been a big hit for residents when they come in. But take a look at that. I mean, you got the white tile backsplash, upgraded cabinets that go right to the ceiling there as well. Stone countertops and overall just professionally designed and staged. It goes a long way. And then the landscaping you can see there as well. Exit strategy, 3-year reno. So we look to go through the units in about 3 years, and then we look to sell in around that 3 to 5 year hold time. So what we tell our investors is, listen, expect 5 years. That's kind of the number, but we will be looking to sell in that 3 to 5 is when we're going to be looking to sell. So the one thing that people ask, okay, well, when do you sell? It's like we want the market to shift from buyer's market to seller's market. And so we want to be buying everything today, but in like 2 to 3 years down the road, the data is telling us that it's gonna shift in a really strong way. So we'll keep you guys posted when it comes to the communication, which goes out on the 30th of every month, like clockwork. If we're one day late, we do let our investors know that we'll actually buy them a dinner if that happens. Now that would be tens of thousands of dollars if that were to happen. So it hasn't happened yet, but it holds us accountable to deliver on the 30th, the monthly update for the property, so you'll know what's happening. Financials, we've done a full rent comparable summary as well. So we've actually walked through the comparable assets, and you can see what the current 1 bedrooms, 2 bedrooms, and 3 bedrooms up top, what they're getting on average, and then what we're looking to get after we renovate. And so we're very confident that we're going to be able to hit or exceed these numbers, and this is what our projections are. And we have actually gone to the asset and we've actually walked through the comparable assets that are out there, and we feel very confident with the 1, 2, and 3 projections that we have. Financing, we are going with Freddie Mac on this. We're projected at that 5.7%, 2 years interest only, and it's a 5-year fixed term as well. So that's actually one of our golden rules that when John and I were said, okay, what are some golden rules we're going to follow? We lock in 5-year fixed rates to ensure that even if interest rates were to go up, we're protected. Protecting the downside is a very important part of how we manage, because we all want to put our head on the pillow at the end of the night and be able to sleep. There's a lot of operators that have and had adjustable rate mortgages, and interest rates doubled, so their debt payments doubled, yet their income didn't go up that much. And so there's a lot of struggling operators now, and that was the number one reason, because they got these floating rate, variable rate mortgages. And so the other thing that's important to know as well is that we're not getting over leveraged on this. So we're bringing 11.8 million, and then the debt side of it. If you were to, so the actual loan to value on this is about 67%, and then we raise all the money for the renovations. So it's not like we're borrowing a bunch of debt where we're over leveraged. We're well capitalized on this asset. And so we feel very confident we're going to be able to take it to the end zone, and we're not going to get starved for oxygen. As I like to call cash oxygen, because like in business, if you run out of cash, you die. And in this case, we've taken a very conservative approach to ensure that we have adequate cash and we're not over leveraged on these deals. Here's our 5-year performance. I'm just going to guide you to the very bottom. Take a look at that cash flow at the very bottom. Cash flow after debt, or after we pay our mortgage. That's over $500,000 that it's producing every single year in free cash flow. This is after we pay our property manager. This is after we pay all of our expenses. It's sitting there. And so this is where distributions come from, is we actually give that back to our investors. And the debt service coverage ratio is very strong as well. So generally, lenders want to see 1.25. This is the net operating income over your debt payments. And so there's a ratio there. And so lenders want to see at least 1.25. And you can see from year one's very healthy. And every year it gets healthier and healthier as we renovate and increase income and overall net operating income. Operating expenses, there's a full breakdown per unit here as well. So if there's ever any questions on that, feel free to reach out. And CapEx, so this is our renovation budget. So we're looking at just under 16,000 a unit for interior costs. We're very confident we're going to be able to hit that, because it is rinse and repeat from our other assets. Exterior, just over 500,000, 513,000. And we do have a contingency here just in case. And so there's the construction management fee as well at the 5% of the overall budget there as well. So this is a breakdown of our CapEx budget, or renovation budget, as some would call it. Tax projections, we bring Ryan in. Now, so Ryan has come in and they've given a range. And so this is the most probable. So when we have our projections there, we can see what was current, but we're being conservative with what we think taxes will go for. Now, what we generally do with our assets is after we close, we actually hire Ryan to go in and actually battle to lower the taxes. And so they create a case, and they actually go and they get a percentage of whatever they lower. So they're incentivized on this. But this is just one of the many things we do to ensure that we can maximize the overall returns for our investors. The other thing is the insurance breakdown. The insurance breakdown is, you can see there, we have hard quotes for our insurance broker, from our insurance broker, which is he's phenomenal, by the way, just phenomenal. And we're very confident with his ability to be able to execute on these numbers. And you can see what the current is and then what projected. So we're being conservative on that side from insurance. One thing I'll say about insurance is that not only does that protect, there's a very low deductible on our insurance, but this not only protects the building. Let's just say a storm came and it just wiped out the building. It'll look after replacement of the building. But here's the other thing that a lot of operators don't think about. Does it cover income loss? And our insurance does. Okay, so income loss, say all the residents need to move out. Well, insurance, we're covered for that they would compensate us for income loss as well. And so that's a big one. Now, we get this question a lot in regards to taxes. Whether you're on the Canadian side or the American side, we've structured the investment to minimize the amount of tax that you're paying, but to also minimize your time that you're actually spending doing this. So on the Canadian side, you're actually investing into a Canadian limited partnership. Those proportionate shares flow down to a Delaware limited partnership, and that is invested into the actual deal itself. The Canadians get a T5013 tax slip, Canadian tax slip, and the Americans will get a K1 tax slip and get all the advantages of the bonus depreciation and cost segregation that they only allow for on the American side as well. So very tax efficient on that side. So at this point, guys, we've gone over everything. You really have two choices right now. When it comes to real estate, I'm a firm believer that real estate in 10 years, we're going to look back at today and say, hey, I wish I would have bought everything, especially now that we've seen pricing come down 20 to 30%. I can't think of a better time in my career than now with the recent pullback and with the strong case for real estate growth moving forward. I encourage you, highly encourage, if it's not with us, invest and buy more real estate. The number one regret I hear from people is I wish I would have bought more real estate. And if you ask yourself really sincerely, you probably are saying that right now is 10 years ago, I wish I would have bought more. Well, you have an opportunity right now to be able to invest. So you have two options. You either invest on your own, you go out and find your own real estate and you do all the researching, you're doing all dealing with all the obstacles, dealing with the late night tenant phone calls and sorting out taxes, accounting and everything. Or we could do this together. And this is actually one of the reasons why we built Faris Capital, is that I could invest in something that I really believed in and build it in a way that was strong enough returns where investors that are busy, they're entrepreneurs, they're super successful, doctors, lawyers, engineers, they can still focus on their craft, but they can invest and get returns that are strong enough and have enough upside that it actually makes more sense for them to invest together than to do it all on their own and to try to look after everything. And so that's what this is. This is built in a way that we can all have very strong returns and do it together. And so this is the choice you have: do it alone or do it together. And I want to encourage you to take action, at least on one of them. And so this is a really big decision that you have right now, because we're at a time in the market where this is going to really reward the action takers. And so this is a big one. So do it alone or do it together. So next steps, if you were to say, okay, Mark, what's the next step? First off, it's very simple to take next steps. First off, in the link, you'll be able to see a breakdown or a reservation form where you can actually go in and make a reservation. Okay. Make your reservation. When that happens, we're actually going to send you back the investor portal where you can go and fill out all the next steps. Very simple. Now, once you fill out the investor portal, that it does need to be approved. And then from there, we'll send you wiring instructions that you can wire funds to our trust account. And then from there, we'll hold on to the funds until we actually close. We are looking to be fully capitalized here within like the next 60 days, and then looking to close about 30 days after that. So that's the timing at this point. And I want to really encourage you guys to make your reservation, not sit on this. And we also have, if you do have any questions, you're like, I'm not really sure, or I'm kind of on the fence, book a one-on-one call and get your questions answered. I really want to encourage you guys, get your questions answered so that it's either a yes or no. And this might be a timing thing. You might have equity tied up in another asset. Still book that one-on-one call so that you can be ready on the next deal that comes down the pipe. But if you are sitting on the fence and you're sitting on cash with inflation and all the other things that are happening, lock in your real estate price today, because this is going to really help you moving forward. The thing that's really important to know is that this is not like an open fund where we're just accepting unlimited amount of funds. There's only 80 spots available on this asset. And so first priority goes to our current investors and anybody that's made a soft reservation. So make your reservation today. If you're like, I'm 99%, book the reservation, have a one-on-one call, and then make your final decision. Make your reservation today. It's really important. Then we send this out to our database of over 13,000 investors, and then we start publicly advertising it as well. So book your reservation, lock in your spot. There are limited spots, and once spots are taken, you need to wait till the last deal. And it's not great for me when I have to tell investors like, sorry, we filled on this. Our last deal did fill very quickly, and I've had to tell people, it's like, sorry, we filled. The good news is on this, timing just worked out really well where we have this phenomenal opportunity, and the timing to be able to get into this is it's just phenomenal. So that's so John, I'm gonna bring John and Georgia back on. And do we have any other team members there, John? I think it's the Georgia and John. And so if there's any questions, we can go through that. But I just want to, thank everybody for the time, and let's go through the Q&A part of this.
Yeah, no, absolutely, Mark. So somebody typed in a question about registered funds. Are Canadian investors allowed to use registered funds?
Yeah. So we are projected, and we plan to have that in place for 2026. So for this offering, registered funds, we're not accepting registered funds on this one. Uh, we have had very strong demand from our investors on this. So there's some extra steps. We're looking at Olympia Trust as a partner on that, and so we are looking for 2026 on that moving forward. So we will keep you guys posted as soon as that allows. But I know on the U.S. side, John, this is something that is permissible on the U.S. side. Um,
Yes. Yeah, it's so if you have funds in an IRA or a Roth IRA, there are ways you can invest that capital. You do have to work through a third party IRA custodian, but if that is of interest to you, if you're in the US listening to this, just let us know. We can help make that referral or that connection. Raja had a question about the current and future cap rates we are projecting. So our going in cap rate is actually 5.64% based on the current financials. We're projecting an exit of a 5% cap rate. We use a lot of data points to make that determination. Of course, that is, we don't have a crystal ball, but what we can look at is history, right? And so CoStar is one data source we look at. They're actually projecting the cap rate in 5 year in that market to be closer to 4.75%. So we, just to be conservative, bump that up to 5%. Historically in the US, multifamily buildings and good market areas trade at about 5%. So we've seen a little bit of expansion there. The compression's actually started already. In fact, Mark, we're seeing some of these newer core buildings that have traded recently in the high four range. Of course, this is an older building, so we're very confident with that projection, but it is a projection, but that is where we're at there now. One other question that same gentleman asked was just about our GP fees, Mark. Like, what are our various fees? Do you mind sharing with the listeners about those fees?
Yeah. So currently right now from a breakdown, there's the acquisition. John, do you want to go through the different percentages there
Yeah,
from?
so it's a 3% on our acquisition fee. So that's to compensate us for, all the due diligence, hunting down the deal and getting it to the closing table. And then we have a asset management equity placement fee that is just the compensation so the team can run the deal through the 5 years, execute on the business plan. Georgia, who you see on your screen there, she is our senior vice president of asset management with over 20 years experience. And I'll just say we don't take I would say we're just one like probably edge away from being like micromanagers. In other words, we stay very on top of these property managers. We thankfully have a wonderful third party vendor, Asset Living, that has an incredible team that adds a lot of value. They bring unique ideas and initiatives to us just the same, but we're going to these assets on a monthly, if not quarterly basis, just depending on travel schedules. We do spot inspections. That's one of my favorite parts about this being in my backyard. I can just slide on down there and just check and see, right? And just see how things are looking. But those are our two big fees. And then we do have a 1% disposition fee to help pay for the brokers. And then, our compensation is largely tied to hitting these numbers, right? 8% of all returns goes to investors before we see a dollar. And then as those waterfalls illustrate. So we are really incentivized to go big for our investors because that's the way we make our money, frankly. Now, all that said, Mark did touch on this, but Mark and I personally invest in all of our deals. And more recently, George has been getting into the mix. So her and her husband are personally investing in the last few deals. So we put our money where our mouth is and we sit right alongside our investors, right? So let's see here. This question, Mark, I'll ask it because maybe you understand.
Yeah.
He's asking about our hedging strategy for Canadian
I see
funds.
that. Yeah, so the big question right now, so if you look at the exchange rate in regards to it, it has recently come down. I mean, just pulling it up right now, it was up at for every dollar US dollar that was being invested, It was actually got up to about a dollar 40. I think it was about 147 there for a bit. It's actually down to 136. 136, 8, 950 is what 895. So that just means for every for 100,000 US, it works out to about 136,895 dollars Canadian. So how we mitigate that, there's a couple ways. First off, all the distributions that come back to our investors are all in U.S. funds. All returns are back in U.S. funds. So majority of our investors are looking to be able to keep their funds in the U.S. and to continue to grow that. Majority of our investors are heavily invested in the Canadian market with Canadian dollars. And so by actually having U.S. dollars there and keeping it more long-term in the U.S. and growing that asset, it's a huge we'll say a diversification play, which is actually a huge reason why a lot of investors are investing because if they look at like a pie, the biggest part of the pie is in Canadian dollars. So that's a big one. The other thing is we have a really good connection with a currency conversion company that can actually give the conversion rate at like 25 basis points. Now, if you go to your bank, so that's like 0.25%, just to simplify that, 0.25%. If you call your main lender, right, or your main bank, and you ask them what they charge, I've tried this before. I had private banking with one of the larger banks, and they just didn't even know. It's like here's their currency. So the currency rate is what it is, but it's very hard for them to break down what they're charging. What they are charging in general is like 1 to 2% of the conversion. And so why this is really great is first off, we'll be able to save right off the bat down to that quarter point, which is great. But moving forward, because the distributions that are coming back in US dollars, that means you have US money coming in. This means when you go and travel down south, you're not having to get nicked every time you are traveling. Oh, I got to exchange dollars. And, generally it's last minute. You just hopefully don't go to the places at the airport where they have those X where it's like that's actually a business, John, that'd be good to get into the currency business there at the airport.
Oh my gosh.
But
Hey,
yeah,
Rob, that's highway robbery.
it's like, but you're in a pinch and you need it, right? But the bank generally they'll charge 1 to 2%, and so that's a way we'll save on that end. But this is really you got to like majority of our investors that are come in multiple of our deals are like, listen, I'm so heavily invested in the Canadian market. This is actually going to diversify me into US, and I want to build some wealth down there so that when I am traveling, I have some funds. And down the road, I'm thinking I might want to, buy property down there, and maybe cut some of the snow out on that end as well. So for Canadians, that really helps. Hopefully, that gives perspective. And I answered the question there about hedging
That's
strategy.
Yeah, and so somebody also asked just about the annual cash returns. So we're projecting, in year one, 5% cash on cash return, and in year five, it will come out. So basically, averages 5.5% cash on cash return across the 5 years. Each year it grows a little bit as we drive additional net operating income, but the first few years of our loan is interest only. So when the interest only kicks in, you'll still see that number rise. But we go basically 505. We're projecting 5.1 in year two, 5.25 in year three, 5.63 in year four, and then 6.32 in year five. So, yep, there you go, Mark. Great.
Yeah, this is really good. So again, the only difference on B, C, and D is the amount that you invest. Okay, that's the only difference. The more you invest, the more you return. So if it's 100,000 that we project, it'll go to 200,000. And just so you guys know, this is not something we're throwing darts at the wall thinking it might go up. We have we have like a 25-page pro forma that is extremely detailed, and the experience that we have on our team underwriting hundreds and hundreds of deals is like we feel very confident with the execution side of it. And so with that, we factor in all returns. I believe our natural rent growth on this was appreciation. I think it was 3.5% that we
Mm.
had factored in, right? So three and a half.
Yeah, yeah,
So
that's
that,
right.
yeah, the market does better than that. I mean, that there's strong upside with that. Now, when you're buying at the bottom of the market, all of a sudden, if the market's gone up 5% a year and we're factoring in 3.5%, that bodes very, very well. So you can see year one, this is what that you can see a breakdown, the 5,000. That what's really important is that every year it grows, but then the other thing that's really important to know is that unlike say if you invest in mortgages and you get interest every month, you have to pay tax on that interest at a you know larger tax rate. With these distributions, we structure it as return of capital. And if you're not sure what that means, you could speak to your account, and it's very tax efficient. When we sell the asset, then the 100,000 is paid back, and the profit. This is it's a capital gain on the upside that you got paid out at, and the capital gain just means that 50%, half of the gain is taxed to your regular income level. So that is the best kind of tax you want to pay versus regular income tax. And so it's structured very efficiently. And so you could see C class is just same stories, just you're investing more, but you're getting paid out more because you have a little bit of a stronger split on that end. And then, the A class, I broke this down for you earlier is that 100,000 would get you $1,000 a month. We do start distributions in that 3 to 6 month. We generally will hit, at kind of the close end of that. But the $12,000 you could see in 100,000 investment, this is return of capital as well. So pretty strong returns, I think very strong, especially knowing that you're in priority, you're getting paid out first, and we're only accepting 1.5 million in on this class A share on that. So hopefully that kind of breaks things down and um, answers that question.
That's great. Mark, I think, Georgia has done a good job as, some kind of questions pop up answering them in the chat there. But one thing I wanted to note here, when we show our projections on our renovated units, the current owner has actually renovated 16 units and they're achieving that rent lift. So this isn't guesswork. We're actually just looking at what they've already been able to accomplish. And what's really cool is that they did a good job, but I'd say they did a good job. We're going to do a great job. So some little extra sizzle will include, we're going to replace the chandeliers, for example, those designer lighting packages, the sinks and the fixtures we bring into the kitchen and bathroom are just a little bit more elevated and tile backsplash. So once again, they're quality renovations, but we just add that little bit of extra sizzle that residents really respond well to. And those numbers have been proven out by that operator. So those 16 units are already achieving that, which is really cool. A lot of our other deals, we're coming in with a blank slate, which is exciting, but it is a bit theoretical, where in this case, it's already happened. And I think you can see as you went through those case studies, we're actually exceeding those projections, right? So we feel that even with those more conservative estimates that have already been proven out, that we'll likely be able to even surpass those just because of that little extra attention we put into our renovations. And I would also add to that, the culture that we create is a huge driving factor there. It's like employee retention, resident retention is top of mind for us. It's very expensive to have to replace a resident. So if we can keep them happy and loving their living arrangement, they'll continue to pay their rent on time and refer their friends and family. So, bottom line is I would highly encourage you, if you have any additional questions or I know some of you listening to this might be an entirely new concept to you, right? You might not have even realized this was a style of investing you can get involved in. So book in that call. We love talking real estate. So no commitment, no pressure. It's just all about you answering your questions, learning more about your goals. So don't hesitate to book in that call.
Yeah, I think, John, I think we hit most of them. I'll just kind of finish up with the last thought for me, and then I'll let you kind of add anything else in Georgia if you wanted to add anything else as well. Is that as a broker, we still on the Canadian side, the sister business Faris team, we sell about 1 billion in sales every year, and so we see deal flow, we see what's out there in the marketplace, and so it should be very encouraging to know that even with all those, with the deal flow, is that as an investment, I think that everybody should own their house. I think that's like a very good thing. If you have extra dollars to invest, right across North America, if you had any place to invest right across North America, this is where we're going. And this is why we built a team to be able to execute in these markets. And it's not just because John's living there, is that we have assets in, Florida and South Carolina, and now we're going into Atlanta, Georgia. And these deals are just better. They're better than the smaller deals. So there's enough, we'll call it uh, cream in these deals to be able to hit these numbers. And our goal is always to exceed our projections. That those are our goals, and the team that we built, the markets that we built, and then the ability to execute and building culture and all the rest of it. We're going after these assets for a reason. They're really we'll call it the crown jewel of real estate investing. I've heard that before, and I totally agree, because the ability to actually wrap up and get one of these is so rare, and the amount of we'll just say uh, um, demand for these is very rare as well. And this is your opportunity to get in, add 114 units to your portfolio as a partner in a very, very strong upside market moving forward. So I want to encourage you to book your reservation, book your one-on-one if there's any questions, and just make a decision. It's a yes or no versus like it's a maybe. And that one-on-one call is the next step for that. If you're like, yeah, hell yeah, I'm in. I'm an action taker and I want to move forward. Get the reservation in so you can lock in your position. And then from there, we'll send you next steps moving forward. But I want to encourage you guys looking back on this, really believe that you're going to be looking back and saying, you know what, I bought in at a really strong time. That's what the data is telling us moving forward. I want to encourage you guys to take action on this.
Yeah, really nothing more for me, Mark. I think you covered everything, but we'll mention that we will be sending out a recording of this webinar. So if you want to go back and review or dig deeper into an area, you have that opportunity. But that book a call link will be there. You could also scan this QR code here to register your interest, and we'll follow up. And you'll also receive an email after that with that opportunity to book in that call. George, anything for you?
No, I think we touched on all the high points. We're very excited about this deal. It's a great community, and I love being able to break into this market. I've had past success in this market before, and just really excited to get in there with Faris. So looking forward to it.
Beautiful. Awesome.
All right, guys. Have a great night. Appreciate you coming on late night. Hopefully you got some dinner. If you didn't, go grab some dinner, and hope you have a great sleep, and we'll talk to you soon.
Have a great day, everyone. Bye-bye.
Bye.